but they're over the 6.8%. They're at a point where they have been, and I think their current asset allocation with their return assumptions they have would cover the 6.8. So,
Gentlemen,
how are you?
oh, good. Hey, how you doing?
So it's a tough one. What I still find the problem with it, they report returns on equities, not in U.S. equities, international development, emerging, which is the standard way almost everybody else in the industry reports.
Can I get 1 second before we start? I have to get this program to go.
Sure. They're double teaming us tonight. They're both on the same side.
Okay. Commissioner Allen,
Here.
Commissioner Jesty,
Here.
Commissioner Marin,
Here.
Chair Castle,
Here.
Commissioner Woodham,
Here.
Commissioner Samples,
Here.
Commissioner Sherbin.
Here. Okay. Next, we'd like to say the Pledge of Allegiance. Please stand. I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all. Thank you. Next, we'd like to approve the order of agenda. Then next is the blue folder items. Do we have any?
There's no blue folders tonight.
Okay. We have the consent calendar, the approval of the affidavit of posting for the regular Budget and Finance Commission meeting as of December 14th.
So moved.
Second.
All in favor?
Aye.
There are no excluded consent calendar items. And Doug, do we have any public participation of non-agenda items?
We have no public participation. There aren't any participants on Zoom, and there are no e-comments.
Okay, thank you. Next, there are no items from continued previous agendas or items. Next is items for discussion prior to actions. And tonight we have CalPERS investment overview presentation to the city of Redondo. Is Stephanie, are you? Okay.
Sorry, this is not turning on. Tonight, we have joining us representatives from CalPERS who will be giving the presentation. And Doug, do you see them?
Yes, I see 3 members from CalPERS up on my screen here. So I believe they're going to share their screen for presentation.
Yeah, let me jump in. This is Kelly Fox from CalPERS, and I think that either Stephanie or Wendy has the presentation and should share it from there. It'd be easier for us.
Sure, no problem. Just 1 second.
Do we get that? Stand by.
Are you just on my screen? Okay, I'll just do it like this. Okay, perfect. Perfect. There should be like.
Sorry about that. 1 second.
And no worries.
Okay, we have your presentation on the screen here.
Okay. So I can go ahead and start if your committee is ready.
Yes, please.
Yes. Okay, so my name is Kelly Fox, and I am the division chief, and I work with our investment office relations team. And along with me are Sterling Gunn, who is our managing investment director of our total fund portfolio management team, and a little bit about what his responsibilities are for managing the asset liability management process, implementing the strategic asset allocation set by our CalPERS board, and providing economic and quantitative analysis to support the investment decision-making process and centralized trading services. Along with him is Christine Reese. She is our investment director of our affiliate investment program, which supervises 9 affiliate funds. She's responsible for the management of those funds, each with a different purpose, different participants, and investment strategies. And the objective of her program is to achieve adjusted returns aligned with each trust's purpose while investing and operating with an efficient and low-cost structure. So I will turn it over now to Sterling Gunn to begin our presentation. So thank you for the invitation. We appreciate it, and we're happy to be here.
Thank you.
Yeah, thanks, Kelly. And good evening, everyone. So I just share some materials, and I focus primarily on what it is we're trying to accomplish and how we're trying to accomplish that. So just as a page turner, I'm just going to skip to page 3 and just touch on our key objectives. And the first objective is just to implementing the board-approved strategic asset allocation, which forms a form of benchmark. And that's a long-term investment strategy. And a few pages later on, I talk a little bit about the characteristics of that strategy. I refer to it as a harvesting strategy, and there's good reasons for that. And then our second objective is to add value relative to that benchmark. And we've talked to our board about the strategy that we're developing, focusing on that value-adding activity. And I will say of the two activities, the first one is a long-term activity, and to some degree, low intensity. The second one, the value-adding activity, requires more effort and is a shorter-term activity. So there's two different time horizons and two different sets of skills for these activities. So if we could go to the next page, this is where I talked about the harvesting strategy. And we can, as a long-term investor, we feel we're well positioned to take advantage of harvesting the equity risk premium. And there's a story here between these two exhibits. So if we look on the left-hand side, for example, you see S&P 10-year rolling returns. So if you pick any particular point, that point, the value is telling you the average, the 10-year average over the preceding 10 years. And what you can see, though, is even on a 10-year rolling average in that left-hand panel, there are areas where it's red, it's below zero. And that's because investing in equities is a long-term activity. You don't get into it and out of it very easily. And there are periods where you will feel underwhelmed and disappointed by results. And that's the nature of the beast. That's what you get if you just invest in the S&P 500 or any other index. You need to wear it for a long time to be relatively assured that you will get positive returns. And that's the benefit of being a long-term investor. So that's the left-hand panel. The right-hand panel is the same kind of data. It's daily data, though. And what it shows us, though, is how episodic equity returns actually are. They come in clusters. There are long periods of fairly quiet outcomes, and then you get into very noisy periods with lots of ups and downs. And this speaks to you need to be consistent, right? Timing markets is incredibly hard. You might be able to do it with a tiny fund if you were incredibly skillful, but even those people are challenged to do it. It's certainly very challenging with a large fund, $450, $500 billion. So rather than trying to time the market, you simply get into the market and you harvest these returns knowing, again, that they're episodic. And you want to be there for those ups. And that means you have to take your lumps when there's some downs. And so that's the story on the right-hand panel. So altogether, what we really have is investing in equities as a long-term investor is a harvesting strategy. You have an allocation and you wear that allocation. And if you're a large long-term investor, you stick with that allocation. That's sort of the key messages. And you might tune it over time because your needs change, but you don't tune it because you're trying to get into and out of the market on sort of an overnight or short-term basis. That's very, very hard work and hard to do when you're very large. Go to the next page. An important part of anything is understanding what risk is. And we've decided that risk is, just as the Constitution guided us, is the risk of loss. People talk about volatility, they talk about tracking error. Those things aren't really risk as such. They're about how returns vary. We focus very, very much on downside risks. How much money might we lose? And that's really, really important. And so what we do is we've chosen a risk measure here, and we look out over the next 3 years, and it's our best estimate of what a significant or extreme loss might look like. That's the work that we do when we're designing the portfolio. So this page was just speaking to how do we view risk? We view risk as losses, and in particular, when we do our work, we focus on what are the sort of the extreme losses that could affect our portfolio. So I'll skip to the next page. Just
Sterling, quick
Yes.
question on this chart.
Yes.
You make the comment or here that the state has mandated that you manage risk without really telling you the tools they want you to use to manage risk. The question occurs, if you didn't have this mandate from the state to minimize risk, however they term it, would the asset allocation be different than your strategic allocation be different, substantially different than it is today?
Well, the allocation depends very, very much on your objective. But almost every objective has some definition of what risk is, and most of them, either directly or indirectly, do speak to loss. Now, if you've been doing this for a while, you've probably heard people talk about mean variance optimization. Now, the thing about variance is it measures both the ups and downs that can occur so if you look at this diagram, for example, you see like a bell curve. And the variance tells you how wide that curve is. And that's useful information. But if you're really interested in losses, which is what the Constitution asked us to focus on, then you focus on the left-hand side of that curve when you're defining what risk is. And the upside is the potential gains you have. So you're trying to build a portfolio where that bell curve is shifted to be as positive as possible. That's that blue line in the center of it. That's the average outcome. You're trying to shift it, maximize that return, and minimize that loss that's occurring in the tail. So not everyone's explicit about that, but it'll come down to a similar outcome. But by cutting to the chase directly here and talking specifically about losses, then we avoid the noise you get by just talking about the width of this distribution. Because you could have the upside highly skewed, and if you included that in your risk measure, it would start to distort your risk measure. And my apologies, I didn't get your name, but I'm hopeful that that's a reasonable answer to your question, but I can try again.
Well, again, the key issue, I think, is we're trying to get a 6.8% return over time.
Mm-hmm. Yep.
And you can do different asset allocations possibly to come up with that. But are we, I guess I don't understand what the limitation from the state means when you talk about conditional drawdown at risk or the risk of loss. Does that affect your target allocation in any significant way? Are you reducing equities? Are you reducing private equity in order to minimize risk?
No.
Or are you looking at standard deviation as the primary risk measurement and trying to reduce?
Right. Okay, so if I step back, there's other clauses in the Constitution. They ask us to balance a couple of objectives. One is maximize return. So that speaks to your question about the 6.8. So you can build many, many different portfolios that can deliver over a long run a 6.8 or is projected to deliver a 6.8. So the question is, out of all those portfolios, because there are many that could do that, you want the one that has the minimum amount of risk. Right, so we have a target return, and then we use this concept of risk to figure out of all the portfolios that might give me that return, which one has the least amount of risk.
So you're solving for the lowest standard deviation for an allocation that'll give you 6.8%.
But not solving for standard deviation, though. We're solving for something that minimizes that risk of loss, right? So we want to make that the left-hand tail as small as possible. And it looks similar. Like if you have a bell curve, volatility has a relationship to that curve. But there's more to it often because the world isn't that simple. So we target a return and we try to minimize losses in the portfolio. That's the way I think to think about this.
Yeah. Okay.
Sterling, this is Mel Samples. First of all, I have a fundamental problem with this chart, and that is that the black line is to the left of the blue line, and at the bottom, it shows that that's a gain.
every place I've ever been, if you're less than the midpoint, it's a loss. Why does that show as a gain?
So here, we're just illustrating the fact that where anything above zero is a gain. It may not be sufficient for our needs. That's why we have the blue line. The blue line tells us what's sufficient for our gains. So the blue line is our 6.8.
Okay.
But the black line is simply saying, here's where you go from gains of any kind to losses. And the Constitution asks us to minimize losses, not to minimize the shortfall relative to, say, the mean, but to minimize losses. So the losses are all to the left of that black line.
Okay.
Is that
So
helpful?
for the city of Redondo Beach, it sounds like CalPERS goal is 6.98%. For purposes of the people that are in the pension system in Redondo Beach, what does CalPERS need to achieve so that we don't have sudden and unexpected additional contributions to a defined benefit program?
Right.
Do we need
So the
6.98 or do we need 5.2 or what's the number?
So our number is 6.8, right? Net of our costs internally. Our long-term actuarial target is 6.8.
Okay.
And so for the PERF, and I don't know the specifics of your area within the PERF, but the PERF as a whole, we are designing it to deliver a projected return of 6.8% over the long term. So I think that's maybe an answer to the first half of your question. It's 6.8 long term, and that's what we're designing for.
Okay, so all of our city contributions are based on the fact that you achieve your 6.8 or according to this chart, 6.98% return. And if you don't achieve that, then we have additional funds that we need to submit in order to get to that number on an annual basis.
I think that outcome also requires some actuarial work, and it would be a better question for the actuary, but the work that we've done in working with the actuaries is 6.8 is the long-term projected return we need to make the plan work. I think built into that is whatever the current contributions are, all these things come together.
Okay.
And that was the tone of the materials we shared 2 years ago in the ALM. We had all three aspects. We had the contribution risk, we had the funding ratio risk, and we had the portfolio risk. And we were illustrating the trade-off between those three pieces. And the chief actuary currently has said that 6.8 is a number that works for us. Now, I'm sure it varies from one plan to the next, so I can't speak to you specifically, but for the PERF, that's the number that we're looking to achieve over the long run.
Okay. Thank you. I'm sorry to interrupt. Go ahead.
No, please. I'm quite happy to have questions. It keeps me focused and probably on the topics you want to be discussing. So, and this chart always, does raise some questions because it's not necessarily technical, but it's certainly a little different than people are used to. So if we go to the next page, please. So here we're just talking about some of the reasons for why the particular asset classes that we have. And fundamentally, and I think I have the chart coming up in a few pages here. Yes, we do. We're trying to build a diversified portfolio because that's the key to minimizing risk, right? So if we want to minimize losses, then we want a well-diversified portfolio. And so each of these asset classes have some role in diversification and minimizing risk, and they also have some role in achieving the returns that we're looking for. And with my background, I tend to view public equity and private equity as sort of one grouping. They're very, very similar. Private equity tends to have a higher projected rate of return, which is something we find attractive, and we can talk a bit about that when we get to the allocation. But it's still part of the equity space. If a company makes widgets, whether it's public or private, they make widgets, and we kind of understand that pretty well. We have fixed income. Fixed income, again, is a very wide range of different products. So we can start from treasuries, which we usually view as risk-free, going up to, high yield credits and levered credit and so on, which is much riskier fixed income. So if I think about treasuries, if I think about short-term treasuries, for example, the role of that would be more preservation of capital, that if there is a dramatic event, that tends to be a good place to have some capital. Whereas when we look at equities, we're looking for growth, we're looking at returns that will help us achieve the long-term goal that we have. And then if we think about real assets, they're kind of in between. They tend to give us a cash return rather than capital gains. They tend to be a good diversifier. Those returns are not highly correlated with equities. So again, a diversifier that has some return characteristics that we find attractive. And then private debt is related to the fixed income space. We've broken it out because we think it's a particularly attractive part of that space that's deserving of its own allocation. So I'll stop there just for a second because this might be a good moment if you have questions about any of those pieces. We can always come back to it. Oh, sorry, go ahead.
Excuse me.
So, yeah, go ahead.
Percentage-wise, how are the current assets allocated?
Okay, so how they are allocated is we focus on building a diversified portfolio. So there's a mix of these assets, which is sort of optimal in a way. You know, there's a mathematical piece to this. There's a sort of common sense piece to this. But the idea is there's a mix when we think about minimizing losses that best accomplishes minimizing losses while trying to give us the projected return that we're looking for. And that's actually where a lot of the hard work is trying to understand the relationships between these different asset classes. So if you, just a highly stylized example, and this comes up in a few pages here. If I could only invest in the S&P and in US Treasuries, there's almost no relationship between those two things. They're very, very diverse, right? Very, very dissimilar from each other. And as we see in a few pages now, you could start with that very simple portfolio, and you would get a portfolio that would give you the returns or the projected returns we're looking for. And it has a risk of about, I think, going by memory, but it's on the page, I think we're about 40%. So that could be a starting point. There's a very simple portfolio. We all understand that portfolio. I have S&P, I have US Treasuries. My projected return is 6.8% in the long run, and my risk of my potential loss is about 40% of my portfolio over 3 years. So that's a starting point. Then we can start adding additional asset classes. And as we do that, the target return stays the same, but we see the potential for loss starts to decrease. Rather than 40%, it becomes 35% or it becomes 25%. That's the benefit of adding additional asset classes, is to try to build a diversified portfolio that reduces risk while maintaining the target projected return. And the magic is just in being able to try to understand these returns as best we can in order to try to build that portfolio. And I know that's a very long-winded answer to your question. You're probably like, how do we actually make this allocation? And it's a month of work to really dig into these asset classes, understand what drives these returns. What are the economic factors? Are there other factors that we think influence these returns? And we have to pull all these things together. And then again, based on our best understanding, offer up an asset mix. And there's a lot of them. Sorry, go ahead.
I'm just curious to know what percentage of total assets is in fixed income
At the moment, about 30%
and public equity
is 42%.
and private.
Private is at the moment 13 and headed north. I have a chart here. I should be able to read this off to you more directly.
It's in a couple of slides too.
Yeah. And these are the kind of things that, we are reviewing now. That's why we have this midterm ALM review, is to ask ourselves, are we still happy with the mix we proposed 2 years ago? And by and large, we are. What we are doing in this mid-cycle review is saying, 2 years ago, we would have liked to have done more private equity than we actually allocated to. But at that time, it was a combination of capabilities and so on, that we just didn't think we could get to a higher allocation in the period of time we were giving ourselves than 13%. Well, a few things have changed. We have new staff, we have new opportunities, and so we do think we can actually get more private equity in the portfolio than we actually thought about 2 years ago. So the one thing we're scratching our heads on and probably suggesting in March is let's increase the allocation to private equity. But other than that, we're basically staying to where we are.
So I've heard you say a couple of times, this is a mid-cycle review. How long is your cycle?
So the ALM cycle is 4 years. And so that, the actuarial information is updated completely every 4 years. But in the middle of that cycle, we do check in and ask, has there been any material changes in the marketplace and actuarial assumptions, anything that really would demand that we change the portfolio?
So essentially, it's a 4-year cycle, and you do one mid-cycle review. And in an economic environment that we're in today, whether that applies or doesn't apply, that's the cycle.
Yeah.
Okay.
Sterling, back up just a moment. You went over the asset allocation for those asset classes. Could you repeat that? Public equity through private debt. What's your target allocation at this point?
So the public is 30%. And then there's another 12% in a separate public segment. So that adds up to a total of 42, but we distinguish one from the other. We have 13% in private equity, 15% in real estate. We have the 5% in private debt, the remainder in fixed income. And then we have 5% leverage, which we use to improve diversification.
And the public equity, the 30% in public equity, how's that divided between U.S. and non-U.S.?
That's market cap weighted. So we invest in a FTSE index, global index.
So it's comparable to ACWI then?
It's similar, yes.
What's the difference in the public equity between the 30% and the 12%? You said there was 12. Yep.
Yeah, so the 12% is a multi-factor. It's intended to be a lower risk form of equity, which hopefully has a better return to risk profile.
Mm-hmm.
And that's an assumption that we are reviewing. It's a newer kind of strategy. It was put in place, I think 6 years ago in the portfolio. And we're regularly reviewing that and plus other opportunities. So we're always looking for opportunities to better improve the diversification in the portfolio. And that was added 6 years ago to try to do that.
Okay.
Are we okay there?
Yes, I think you can move forward.
Sterling, while we're on this page with the asset allocation, let me ask a question. In the material you sent, I don't see returns. I saw returns for private equity and some of the other categories, but I didn't see a separate return for public equity over time. Did I miss that? Was that included in some of the material?
Kelly, I think we may have lost Sterling.
Oh.
Yeah, I don't see him on the screen, so I think
Yeah,
we may
he
have lost the
froze.
connection.
His video froze, and so I think he'll probably be dialing.
Yeah, it looks like he logged off, and we'll try to log back in. So give us just a second here.
Okay.
Yeah.
And a lot of the allocations that you guys were asking about, it's on slide 9. He just hasn't gotten to it yet.
Oh, okay.
The interim target weight as well as our long-term weight.
Got it. And then I can try to answer the question. Did you just mention that there were returns provided in the information we sent through for equities, public equity, but not private equity? Do you have a page that?
I haven't seen that. I don't know.
Okay.
The only returns that I've seen are a couple of pages further back on this where the total returns for the total portfolio are
For
shown.
the total portfolio.
1, 5, 10, 20, 30. But
Yep. Okay.
it's a further breakdown of that into those same categories that we've just been looking at here.
Okay.
It's what would be useful.
Yeah, I think early on, Stephanie had indicated that you had received information from the actuary, or you had some documents that had been provided earlier. So we just didn't replicate that in this presentation.
So I think what you're referring to, and that may have been a bit of a miscommunication on my part. I think what he's referring to is we were informed of these quarterly reports that CalPERS does provide through their investment committee. And those give detailed, I believe, those give detailed performance by asset classes. Again, this is something that is publicly available on the CalPERS website, and we can share.
Okay, so we haven't received it.
Thank you, Stephanie.
You have it, but we haven't received it.
That is true. And the CalPERS representatives on the call can, support this or underline what I'm saying. I'm referring to the quarterly, I believe it's called the quarterly trust statement. And these are presented at your investment committee
Correct.
meetings quarterly. So this is something we discussed with Paul. Is that correct, that that's an appropriate reference to direct our committee to?
Yeah, that would be perfect. We have a more comprehensive trust level review that you can go back at the September board meeting, and it'll give you a lot more information. But yes, we do provide quarterly updates.
So can staff send that to us?
Yes, definitely.
Thank you.
And Stephanie, if it helps, we can make sure to send the links to you.
That would
whatever
be
works
great,
best.
actually. Yes,
Okay.
that would be perfect.
And that information is quarterly? And is that information that how do we get that information?
It's publicly available on the CalPERS website. Again, this is something that, as our actuary told us, it's not super easy to find, but it is publicly available on the website. You'll get the board meetings, find the investment committee, and they post all of these reports. I believe, probably at some period in advance of the meeting, the CalPERS team here can correct me. But I was also able to see an agenda for your upcoming March meeting with the quarterly reports on that agenda as well.
Correct.
And if I may, on the preliminary Q&A that we provided for yourself, the city treasurer and city manager, we listed the link to how to approach that. Just after this meeting, we would roll out how we're going to get that information. But it is publicly available, so you can research it as you'd like, and we do have the links and everything to that. So we'll get that straight so that we can get in a routine and flow.
Okay.
Yeah, so Sterling has sent me an email and said that he's rebooting his router. So if we want to move forward, I think Christine can probably walk a little bit through this, and then when Sterling gets back on, would that work for you, Christine?
Yep, that works for me.
Yeah, thank you.
Yep. So I think we just completed the slide, which was the role of the included asset classes. So, yep, we're on the capital market assumption slide. So as part of our asset allocation process and the mid-cycle process as well, one of the very important exercises that we do is evaluate the capital market assumptions. So what this graphic is showing, and just a moment, I need to enlarge it for my own screen so I can see it a little bit better. So what this is showing is the light blue box for every asset class across the graphic is representing a range of responses from a survey that we put out. We survey several providers on a quarterly basis, so we keep an active understanding of kind of where returns are in the marketplace. So the light blue box, as I stated, is the range of outcomes. So for example, you can see the very first asset class on the left is private equity, and in our survey of the 15 providers, they have come back with a quite, the widest range across all of the asset classes. And, that makes sense. I mean, private equity is a lot of people have a lot of different views on the forward-looking returns for that space, and there isn't as much public information about those corporations. So then, as you kind of move to the right, look at some of the other asset classes, the range of outcomes It's a bit more narrow. The blue dot for each of the asset classes represents the median value for the responses for the asset classes. And then the orange dot represents the median value that was used in the 2021 asset class. So you can see by and large that returns have increased, significantly, relatively speaking, for fixed income. They've dropped down for private equity, and in some other cases, they've stayed relatively stable. And I see, hi, Sterling.
Yeah.
So
my apologies.
That's okay. Okay. So these are the capital market assumptions that then flow into the analysis for the asset allocation and strategic asset allocation mid-cycle review in terms of kind of looking at the forward-looking kind of projected 10, 20-year returns for each of the asset classes in terms of helping us decide kind of are there going to be any changes made to the portfolio. So I'll stop there and see if there are any questions on this slide.
Yeah, a couple of questions. First, it would be helpful to have a specific returns on this. I have trouble looking at the chart and determining whether the range between private equity and public equity is 4%, 5%, or 6%. It's difficult to figure that out. So that's point number one. It'd be good to see the numbers associated with the dots on an additional chart. But then the other thing that strikes me is that in some of these cases, the figure that you all have used in your asset allocation study is significantly above the consensus chart, and in other cases, it's significantly below that chart. Could you explain that?
Yeah, so I can try to answer that, Sterling. Okay. So the blue bar is representing the range of the most recent survey that we took, and the blue dot is the median value within that most recent survey. The orange dots are outside of the current range, but if we were to look back at the materials from a couple of years ago when we set the asset allocation, those orange dots would have been within the range of values for the survey that was completed at that time.
Oh, I'm sorry, I misunderstood. I thought the orange dot was what you all had used. My mistake, sorry.
So the orange dot was the median value from 2 years ago, which is what we used going into the ALM from a couple of years ago. But it was within the range at that time.
Yeah, okay, got it.
Okay.
And that's a useful thing to keep in mind. So we could put the numerical values on here. The reality is 1 quarter to the next, these ranges do jiggle around, and these median points do jiggle around a little bit. And so part of the work is to not get caught up in the quarter by quarter changes, but rather have a good understanding of where the middle ground is, for the long run, and focus on that. And one thing we do, we presented to the board, because we have these range of potential returns for each asset class, we do share with the board, for any particular portfolio, there's then a range of projected returns. So even though we're looking to get 6.8, which is sort of the median value, every portfolio has a range, usually from something like around 6 to around 8. And the median value is at the 6.8. And our intent is to not anchor on an extreme estimate one way or the other, but to try to stay in that middle ground when we design the portfolio and when we use these CMAs.
What sort of difference are you seeing between private equity and public equity? I can't read the chart on the side. How much of a premium are you expecting to get out of private equity over public?
Right. So the survey is for private equity funds, specifically LBO funds, and it's about 80 basis points now. So it's narrowed over the last 2 years. And so an important part of our strategy is to minimize as best we can, our exposure to funds. We have co-invests, and we try to make sure we can improve that spread by avoiding the fees that tend to come along with private equity funds. We also look at venture capital and other flavors of private equity to diverse that portfolio somewhat. So I just want to be really careful. And it's not clear on this chart here. That is for LBO funds. And private equity is a very broad asset class with many different flavors.
Yeah, well, that's the question I'm asking. The broad private equity class in your work now, how much of a margin, how much of a premium above public equity are you expecting to get out of private equity, and how much have you gotten in the past?
Right. So again, here we're looking at the most scalable component, which is the LBO funds, and we are expecting 80 basis points for that version.
$80 basis points. Well, again, if you're looking at fund, you say funds, you mean fund of funds or?
No, just a fund. So a private equity fund, an LBO fund.
And is 80 basis points what you've experienced in the past?
It's varied. And I would say you have to look at the market and rather than our particular experience. I think the market overall, that's probably been wider historically for many different reasons. And I think going forward, it's a tougher market than it was in the past.
No, most of the asset allocation work that I've seen looks at trying to get about 300 basis points more out of private equity than public equity. If at 80 basis points, I mean, 80 basis points is 80 basis points, but I'm surprised that you're not getting, your target isn't, for private equity, isn't a whole lot more than 80 basis points.
Right. So don't forget, this is based on a survey of expert managers and consultants that are out in the field whose business is to think about these things, and this is the median value.
Yeah, but that's why I ask, what is your, forget about what the survey shows, what are you all expecting internally between private equity and public equity? Right. Is it 80 basis points?
No, we hope to get better than that. And I'll be a little bit dodgy on this because there's some proprietary information in our strategy that we just do not want to be in the public because that would compromise the strategy. But our intent is to do better than this.
Well, there's nothing proprietary about telling us what your target returns are.
Well, I think, these are the target returns for the portfolio. The other activities are active. And again, when you're active, the less, the world knows where we're trying to play and how we're trying to do that, the better off we are.
Okay.
So if I draw a line across your chart from left to right at 6.5%,
okay,
you have private debt just barely touches that line for your Q2 2023 survey. Private equity is just barely above that line. Everything else is below the line. To me, as a novice in this, it tells me that everything's going to underperform your 6.8% goal.
And that speaks to the earlier conversation about the benefit of diversification. Not everything has to have the target return in order to contribute to building a good portfolio.
Yeah, so but you got to have, wait a second, you got to have as many above the line as below the line to meet your target.
So if we look at, let's just pick on private equity just for a second here. And if I read it off here, it's almost 8%. So that's 120 basis points over our target projected return.
And the other 11 items are below the line.
I understand. So just let me walk through the pieces here. So we look to the equity, both public and private, and we look to the private debt as the source of the returns that are going to drive the overall outcome. And those pieces, so we have 42% in public equities, we have 13% in private equity, and we have 5% in private debt. So if we add that up, we're somewhere north of 60% of the portfolio in these higher returning asset classes. And then the role of the others, they still do contribute. They're a little bit below, but they don't entirely offset the gains we're expecting in those asset classes. But we will have a better, more diversified portfolio from a risk perspective. Still projecting to hit the 6.8%. There's no magic in the numbers here. Like we haven't fudged the numbers. These are just arithmetic relationships. You can take the weights, look at the projected returns, and you get to the 6.8.
Yeah, I get it. I just, when I see 11 out of 12 are underperforming, I have a real hard time figuring out how number 12 is going to make up the difference.
Well, again, it's the weight in the portfolios that's important, not the number.
Because yeah,
So
this
we
is
have
not
a-
indicative of the weight. This is just what CMAs are saying that this is not necessarily how they're weighting what they're buying.
Yes.
Okay.
So we have a
Okay.
very, yeah, I mean, 6.8, to your point though, I will say, is a high projected return in the kind of environments we're operating in, which is why you see our portfolios so heavily weighted towards equities and risk, as opposed to treasuries, which are much safer. Another feature here, Christine pointed out, the orange dots. You notice the orange dots for fixed income were much lower 2 years ago. So that was a time when much of the world was thinking even U.S. treasuries were not going to give a very good return over 10 or 20 years. And so in that environment, we certainly tilted towards equities to try to achieve the 6.8. Now, as the world's corrected a little bit, we're getting back to a slightly more normal world where interest rates are a little bit higher and returns on fixed income are a little bit higher. We are adjusting the portfolio a little bit, but we are still a very equity-centric portfolio.
Would you say you are committing enough to private equity and not too much, or would you say it's not enough?
We are hoping to increase the allocation a little bit more, but we have to balance the desire for returns against the desire for liquidity. And there are many different aspects to liquidity. We have more than sufficient liquidity to pay our bills now and in the future. That's not the kind of liquidity we're worried about, but more the ability to, if we commit to strategies, to make sure we don't have to unwind strategies to provide liquidity. So that's the balancing act. Private assets, higher returns, certainly very attractive. We would like to do more, counterbalanced by we have to maintain some diversification in the portfolio and maintain a certain level of liquidity. So there's always these trade-offs between return and the different kinds of risks that we run in the portfolio. Good question, though. Thank you.
An article in the Wall Street Journal a couple of months ago said that you missed out on $11 billion in gains by not committing enough money to the private equity. Would that be a fair statement?
In fact, I think that's a statement we might have made in last September's board meeting. So I'm glad that the Wall Street Journal was able to read our materials. Yes, indeed. We did say something. We provided a range, but that's certainly in the range of outcomes. And so you'll notice, even before Nicole arrived, I must say, we increased the allocation to private equity in 2021, and we are now discussing doing the same now. And the trick to this is consistency. Like many of these things, I spoke earlier about public equity and harvesting, and the idea there, you have to be consistent. You just have to be present because the returns are very lumpy. Most of the asset classes are no different. You have to be consistent in your approach to investing in these things. If you try to time them, that's an incredibly difficult and challenging environment at the best of times, and particularly when you're large, like we are. You just need to be consistent. And I would say, something that I think the mea culpa a year ago is we had not been consistent over that 10-year period.
So how often do you rebalance the portfolio during the year?
We rebalance quarterly. Now, when we rebalance, I should be careful. We rebalance around the private assets. So if we are a little bit overweight private equity, there's no need to sell private equity. Private equity and public equity, as I mentioned earlier, if you make widgets, you make widgets. They're very similar. So we'll rebalance using the public asset classes to maintain the overall total portfolio risk and stay as close as we can to the allocations that we targeted. But the allocations are targets, and they're not something that we have to be completely strict about hanging on to.
Are there any restrictions or caps on how much you can put into any one individual asset class?
I can't say that there's restrictions, there's capacity limits. How much of an asset class is available certainly influences us. That's what influenced us 2 years ago. We didn't think there was sufficient capacity for us to go from 8% to 13% over a short period of time. And we surprised ourselves for a number of reasons. So it's more about capacity, but also the intent to design a good portfolio, a diversified portfolio. We don't want to just load up on equities. That's probably not a good way to achieve the outcome.
Yeah, no one wants you to do 100% in private equity. That's why I was, I guess, asking, is there any type of limitations in terms of how high of an allocation you can go?
Only in terms of the allocation process itself and what we think the capacity is. And capacity also includes how much liquidity do we want.
Yeah.
Right? So there's always that balancing act.
Sterling, the articles that were mentioned a moment ago talked about trying to catch up to the target allocation for private equity. 13% is the target now. What is the actual?
We're actually at just about 13%, give or take.
Okay. And I recall an article also that indicated you were talking about changing the approach internally from funds to doing direct investment. Is that correct?
Something similar to direct investment. So we are thinking about co-invests. That's a way of avoiding fees, and so that's an attractive way to do things if you can, yes.
And what, of the 13% actual and target, how much of that would be co-invest? Is that?
Well, I'd say internally we have some idea, and again, that goes back to our strategy, and we really don't want the world to know much about what we're doing until we're finished implementing. But I will say in most of the private asset class, it's opportunistic. There are times when there are great opportunities in the market and you try to seize those opportunities, and there are other times there aren't as many opportunities, and so maybe you slow down a little bit. So we try to be consistent on all these fronts, right? You need fund relationships because we are not a large organization as much as we would like to think we are compared to other places. So we need people that can help us source good assets and build a pipeline of potential assets that we could invest in. So we always have to have some kind of fund relationships, but we like co-invest because that helps us avoid fees. So we always try to strike a balance.
And of the 13% in private equity, how much is venture and how much is buyouts?
It's still dominated by buyouts at the moment. It's something that's a balance we'd like to change. It's also very hard to scale up venture compared to buyouts. So it's not as if I think venture will ever be like the majority of it. That's not the case, but rather the team would like to build a more diversified portfolio.
Are you, where do you stand on hiring a new CIO?
I'm not involved in that process, so I can't give you any information on that. I'm looking forward to it. Because whoever that is will be my boss, and so I'd like to know who I'm reporting to. But I'm quite happy right now with Dan. There's been a lot of good continuity. We worked with Nicole for 18 months. We've built out a good strategy. The team is very committed to executing that strategy, and an important part of that strategy is the private assets, and we feel capable of executing it now. So I don't think there's so much waiting. I think Kelly wants to get in on this a little bit. But
yeah, just to let you know that that decision resides with the executive's office, the chief executive office, and the board. They are making that decision and working through the applications as we speak. We have a consultant that's on board, and I think they're whittling down the numbers. We were very surprised and pleased to have like over 50 applicants for the position. And so it'll take a little time to whittle through that list and come up with the best candidates. And they're optimistic to have something by the spring, but we all know that that's optimism and not always realized.
I'm afraid we disrupted your presentation pattern. So if you want to go back to that last chart and start again, I apologize for getting you off track.
No, I think we're here to answer your questions, and I think that's what we're doing, hopefully reasonably well. But we have been talking about the CMAs and just about the range of outcomes. And that's, that range of outcomes is often neglected when people talk about portfolio construction. And again, I mentioned earlier, the projected returns, when you take all this information, for any one portfolio that we consider, the range is actually it's not 6.8 projected guaranteed. There's a range of outcomes, and it's more like 6 to 8, with that being the middle ground. And And that's one reason why we have an ALM process, and this sort of mid-cycle review is an SAA is not something you just set and forget. You have to review your assumptions, and if you see big changes, try to react to that. So that's an important message that comes off of here.
What are you getting with the mid-cycle review? Or you'll come up with a figure that compares to the 6.8 is what you did 2 years ago, right?
And that's still our projected target, yes.
Yeah. But the mid-cycle review, you clearly see some differences between the consensus 2 years ago and now. Have you done a back of the envelope with this to see how it compares to the 6.8?
We did. We spoke to the board and showed them a couple of candidates in, I think that was November. And the portfolios are similar. The biggest change for us is just again, try to increase the private equity exposure if we can. That means taking maybe a little bit of the equity away to balance the portfolio. But no major changes. On the one hand, right, the equity returns have come down a little bit, like private equity returns. On the other hand, fixed income has come up. So overall returns are still pretty much on target. Overall portfolio risk is still similar.
Okay, thanks.
Yep, you're welcome.
So I just have one quick question. You mentioned in terms of the range of returns, it should be from 6 to 8%. From our standpoint, from a planning and potential UAL standpoint, I think that's why we're so focused on the 6.8 and anything below that for us, it de facto being a loss, not just an absolute loss at zero. So when we look at numbers or think about budgeting going forward, we should expect that much variation from 6 to 8, or I think it was 5.8 as of June 30th.
That's the kind of variation that comes with the marketplace. Like, these are expert opinions.
Right.
And and so the experts, their opinions vary enough that depending on who you speak to, we could show them the same portfolio and someone's going to say 6% projected return, someone else will say 8. So we sort of focus on the middle ground. The one thing we know is, it'll probably be different. And
Right.
the question is, you can either pick a really high return and then be very disappointed. You could pick a very conservative return, but then that would increase your contributions. So by picking the middle ground, again, it's a balancing act between the desire to minimize contributions and the likelihood that you're going to be disappointed.
Okay. Thank you.
Was that clear? I was a little bit convoluted, but.
I understood.
Okay. And again, that 6 to 8 will vary from one survey to the next, but that's roughly consistent with that kind of a range of outcomes over the projected period of time. And again, that's why we have this review process, because if the actuary can review his assumptions, we can review our assumptions and change things if we need to.
And again, that 6.8 is a targeted return for what period of time would you say?
20 years.
20-year
20
return.
years.
Okay.
Yep. And that's why I shared that exhibit earlier showing the 10-year rolling window of equity risk premium, that even over a 10-year period, you can be disappointed. And that's the nature of the market. That's not something you can change if you are in the business of investing in equities on a large scale.
Okay. Great, thank you.
Okay. So that does take us to the diversification topic, which is the next page. And I spoke to this, so I'll just go over it just briefly, because it does touch on a point that I haven't spoken to yet. So on the very left-hand side, so what we have plotted is the amount of risk of potential loss. And so the losses are measured as a percentage of the portfolio on the left-hand side. So if you look at the leftmost portfolio, it's just global equities and treasuries, a very simple portfolio, public equities and treasuries. And it has the potential loss of around, 35%. Now this is a portfolio that, projected return of 6.8, but it has a significant amount of loss. It's not very well diversified, but it's easy to understand, so it's a good starting point. Something we spoke to the board about 2 years ago was leverage. And people usually think of leverage as a way of juicing returns. And we actually take a different perspective. We use leverage to improve diversification. Because if I borrow $5, I can buy $5 worth of bonds. And I can then sell some, those $5 worth of bonds, I can sell a little bit of equity. Not $5 worth of equities, but maybe $1.50 of equity. And by doing that, I've improved the diversification in my portfolio by using leverage. So that's not the same thing at all as buying more equities with my leverage and just increasing the return. I would have also increased risk. Our approach is better diversification with the careful use of leverage while maintaining the target projected return. So in this example, that second orange bar from the left is we started off with that simple portfolio of equities and treasuries on the left-hand side. We added a small amount of leverage, 5%, and you see a modest reduction in the level of risk. So that's an element of portfolio construction. We go to the third column, and we've added investment-grade credit. And that also improved diversification. The risk has decreased. Still have the same projected return of 6.8% for these portfolios, but we've reduced the risk. The last step is we add the private asset classes, and we've reduced the risk again. So in this example, you see the risk going from about 35% with a simple portfolio to a well-diversified portfolio on the right-hand side, which has a risk of around 15%. That's the benefit of diversification. That's the benefit of doing all the careful work of trying to understand the asset classes and their risk and return characteristics so we can try to mold and craft a well-diversified portfolio, reduce risk while maintaining projected returns. And that's the intent of this slide, is just to illustrate that. Are there any questions about that? I'm afraid I can't see the council, so I don't know if people are scratching their heads or what. But
So when you go all the way to the right-hand bar, and you say that you've reduced the risk to 15%, is that saying that the goal of 6.8% times or minus 15%, so that would be about that would be about a 1.5, not quite a 1.5% drawdown against the 6.8. So it would really be, you could envision a 5% performance, and that's still within tolerance. Is that what you're saying?
So this is the drawdown risk measure itself. So that measure of loss that we talked about on that earlier slide, we look at what losses in the tail of the distribution look like. It was about, I think, so this is that tail, that risk measure.
So it is actually a 15% drawdown?
Yes.
Okay. All right.
And
Yeah, so
Sterling, that's during a 3-year period of time.
Right, over a 3-year period. And just be clear, not by the end of the 3-year period, but during the 3-year period, we ask, what's sort of an extreme drawdown at any time during the 3 years.
Okay.
That's the methodology.
Okay.
Is that helpful?
Yes, thank you.
You're welcome. Okay. We've touched on that. I think we already, my pages here are a little bit out of order. So we've talked quite a bit about, this is page 9, I think this is the allocation. We talked quite a bit about the allocation already. I don't know if there are other questions here. If not, go ahead.
No, I was just going to say, I think you covered most of these earlier.
All right.
In the presentation.
Okay. So then the last page is just a summary of performance over the year, where we ended up, along with information about our historic returns over the last 1 through 20 years. And
this question came up earlier in the discussion. Your actuarial assumption now is 6.8%. Over the last 20 years, that was higher and has come down. What was it at its peak? 8%?
Oh, that's a good question. I haven't been here long enough to answer that question for you. I don't have that kind of institutional memory available. I'm sure we could find out. I'm sure it was certainly, I think it was 7% when I got here. And I'm certain it would have been higher than that before, like 7.5 maybe.
Yeah, not a major point. I was just curious.
Yeah, no, but it's a good question though. what are we competing against? That's a good question. And, if you do look at this, we could look at the 1-year result here and we can express disappointment. It's 5.8, it's below our target. But that's why all that effort earlier on about, harvesting equity risk premia is not a game you play over 1 quarter or 1 year or even 5 years. It is a long-term game. You have to be in the market, be consistent. And you do see that over the longer horizon here. The 7%, 10 or 20 years, that really speaks to consistency, because we have had negative returns in 1 year. This happened a couple of years ago. We've had extremely high returns in 1 year. And it's just really important not to get too caught up in the short-term outcomes and really focus on the longer-term stability that we're trying to find in the portfolio.
How have other public, large pension funds, how have they performed in comparison with CalPERS?
Good question. And I would say some better and some worse. And I think it's really important when I answer that question, though, to say that different plans have different risks that they are running in their portfolio, have different liabilities, and that's why they run different risks. So it's actually important to sort of balance what was my return against the risk that I ran. That's one question. And the other question is, was that level of risk and return good enough to meet my objectives? That's why I started with the objectives at the very beginning about what we were trying to accomplish. So I realize that's a bit of a mealy-mouthed answer, but we'd have to find people that were running the same kind of risk, had the same kind of liabilities, and compare. The one thing I will say, again, that mea culpa last September, we spoke to, the disappointing outcome that, we'd contributed to around private equity, $10 or $11 billion. I guess others who maybe were more consistent over that period than we were might have harvested some of that premium and we didn't. And that's something we've acknowledged. And, part of our strategy, and again, team commitment going forward, is that's the kind of thing we want to avoid by being more consistent in our approach to investing.
It seems the median return for the last 5 years for large pension funds was 7.8, and for CalPERS it was 6.7. So it's quite a difference.
Yes, and again, how much risk were people running? So, for example, if we go back to that simple portfolio, let's say our portfolio is similar to 70% equities and 30% treasuries, just ballpark. Someone else who had a portfolio that was 80% equities and only 20% treasuries, they should do better. And the question is, did they do better on a risk-adjusted basis or not? We have a target of 6.8, so we have the level of risk we believe will meet 6.8. We're not trying to generate 9%. Our risk level is set by our board to try to meet that objective. If someone else has a different discount rate, 7.5, they will run a different level of risk and they will have a different outcome. I come from a country where the discount rates are around 4% and the level of risk is much lower. And they're for different reasons. So it's very hard to compare returns without having a more detailed conversation about what are our objectives, what's our discount rate, what kind of risk are we running to try to achieve that projected return.
Thank you.
Can we go back to your last chart?
Certainly.
That one. So if I understand this correctly, we're 2 years into a 4-year cycle. You've set your policy for 4 years, which is not intended to change for at least 2 more. Your 1-year return is 5.8%. Your 5-year return is 6.1. What would make me believe that between now and 2 years from now, you can get anything close to 6.8?
I guess that's a good question in terms of what I could think of that would make you believe that. So when we've talked to all those experts and done that surveying, and we've worked very hard to understand that, they're saying, again, these are 20-year projected returns. And the reason for showing you even the 10-year rolling window is there's very little predictability from 1 year to the next is what you might get. So the portfolio is designed, projected to give us 6.8%. What's the probability of being above or below that in any given year is about 50-50. Because that's the nature of returns.
Okay, I'm not talking about any one year, I'm talking about the next two before you do your next cycle review and
Yep.
change your investment plan, because so far, you're not achieving the 6.8. And if I understand things correctly, our pension payout and our obligations are based on that 6.8 number.
That's correct. That's my understanding as well.
And anytime you underachieve, we have to dig into our pockets.
I think that's also correct. And I also believe anytime we overachieve, then you get a credit. So the idea is if you have that 6.8 in years that are disappointment, and it's amortized over 20 years, right? So you may have to dig into your pockets a little bit this year. The following year, if it's above the 6.8, you get a bit of a credit and you have to dig into your pockets a little bit less. So that's more a mechanism to try to smooth around the 6.8. But the other part of your question is, again, we aren't waiting until every 2 years. We are looking regularly at the portfolio. And given the information we have to us, this is a reasonable portfolio, a good portfolio, which should give us the returns we want over the 20 years. But as those exhibits show us, it's a bumpy road, right? And you can't avoid the bumps in an equity-based road.
Okay.
I know that's not a very pleasing answer, but it is the nature of investing in equity markets.
Well, it just kind of strikes me that your investment horizon for the current situation is far too long, and therefore it's far too volatile.
Interesting. Because, I mean, one, that's the reason for reviewing this regularly. But I think the 20 years tends to be less volatile. You're far more confident that over the 20 years you're going to get that 6.8 than you are over the next day or the next quarter or the next year.
Okay, well, let me do this for you. If we have people that are retiring this year, then they're on drawdown from this pension fund starting this year, and they don't have a 20-year horizon. The new hires have a 20-year horizon. So when we have out of pocket this year, then we need to figure out on our side what makes sense. And do we create a fund in the background in our own budget so that we can accommodate the shortfalls? Or can we rely on performance of your portfolio? And that's kind of where I'm going with this.
So there's a lot in that answer, and a lot of it's really beyond like the actuarial aspect of that. Really it would be indelicate of me to touch upon. I'd be, beyond my deep understanding of things.
Oh, it was a rhetorical question.
No, but it's a fair question. And I guess we all find different ways to manage through, again, what it's like to be equity investors, whether we do it as individuals or as institutions. We all have to be cognizant that it is a bumpy road.
I don't have anything else, sir.
Sterling, a curious question. In the printed material that you all sent, you had another chart, another slide that showed affiliates performance summary. I don't understand what that is and how that relates to us.
Well, that's a good segue for me to step out of the way and let Christine speak for a little bit here, because I've sort of hogged the limelight here.
Yeah, so in addition to managing the investments of the pension fund, CalPERS also manages 9 other trusts, and those trusts are represented on page 11. So we have 3 defined benefit trusts, judges 2, and the legislators. We have a couple of health and welfare funds, the healthcare fund and the long-term care fund. We also have the CERPT, which has 3 strategies, which I believe you may be invested in. That's for pre-funding retiree healthcare benefits. And then we have the SEPT trust, and that has 2 strategies, and that is for pre-funding future pension payments. We also have a defined contribution program that we offer out to municipalities and agencies. We didn't represent that here. It has 16 different funds, and so to kind of save real estate, we didn't show that particular program. And within that program, there are 2 trusts. And so this doesn't directly relate to you, but we did want to at least, kind of represent the entire, kind of footprint of the investment office. And like I said, I do believe that you may have some investment in SERPT Strategy 1 to pre-fund your retiree healthcare payments.
And that's accurate, we do.
Okay, thanks.
You're welcome.
Okay, I think we're ready for the next slide. Thank you. Are there any final questions for?
If we may, I had the city treasurer who would like to come up to ask some questions, if that's okay, so
Yes.
we can give him that time.
Thank you, Ms. Colazo, members of the commission, Eugene Solomon, Redondo Beach City Treasurer. Thank you for your indulgence. Thank you, Kelly, Sterling, Christine, for the presentation tonight. I find it very helpful. I do have a few questions about the presentation, if I may. Sterling, you had talked about the, or just some comments, and then I can step aside. You had talked about the asset allocations, and when talking about the rebalancing on a quarterly basis, if you find that your target allocations are based on returns, altering your target allocations, do you go in mid-cycle between those quarters and look to rebalance, or do you wait till the quarters end? So if you find yourself dramatically outside based on returns, the asset allocations, how do you typically handle that? If you're overweighted dramatically in one area, and that might just be a product of your portfolio designed to expect for that or plan for that. But considering your constitutional mandate and some of the other issues within your strategic objectives, just curious how you handle that part of it.
So,
Sorry, go ahead.
if you don't mind. So rebalancing is actually a contrarian strategy. If you think about it, and I answered quarterly, and I don't want to be too specific because, again, when you come to market and you want to buy or sell, you don't want people waiting for you. If a portfolio is, say, overweight equities and underweight treasuries, it's probably because equity valuations have gone up. So it's a contrarian view then to say, we're going to sell a bit of equities and harvest some of that gain, and we'll reinvest that in the bonds, which maybe are a little bit cheaper. So it's a contrarian strategy, which over time evens out the portfolio and adds to the value of the portfolio. Is that an acceptable answer or a good enough answer?
I think so. I think more directly is whether that's automatically rebalanced in that manner or you actively manage that experience.
So those are 2 very distinct things. Rebalancing is something we do as a discipline. Separate from that, if someone has a view on equities or treasuries or anything else, you can express that view independently of rebalancing, and then you just net out the results at the end.
And you
But rebalancing, rebalancing is not about taking a view. It's about that discipline of being contrarian and rebalancing your portfolio to the level of risk that you want to be running. It's a strategy independent of the other strategies that you might run.
Okay, independent of the quarterly review.
So independent of other active strategies or other strategies in the portfolio.
Okay, thank you for clarifying that. When you had the assumptions from the CMAs up on your slide 7, and you had the discussion about that, are these assumptions net returns, net of fees and other costs, normal costs, or are these when you're targeting? Are you targeting this as a net return or a gross return?
This is the return we expect to get. So this would be net.
Okay, thank you for that. And you had mentioned I'll use your term, the mea culpa in some of the things, not to call you out on it, but a lot of turnover, management turnover within CalPERS obviously changes or adjusts and adapts the philosophies as you all move forward. So I know that a new CIO comes in, there's a new board that comes in, there's changes on the board, and a lot of these strategies and asset allocations and things can change. And I think that's why perhaps there is more long-term planning going on. You don't want to reset mid-cycle because you don't want to be reactive. You want to be proactive. You want to plan out. So just in response to some of the questions about or the concerns about whether or not we're going to meet targets, pretty consistently, we're not going to be out looking to chase down returns, and philosophies don't typically change overnight. They're a little bit more organic when you bring in new people, new CIOs, new board members as to what they might like to see. I think is a way of looking at it as well. One last question, if I may, is that we're currently funded in our miscellaneous and our safety up over 90%. A couple of years ago, we issued lease revenue bonds and made a substantial payment into CalPERS. Do you feel we have more assets at risk, essentially? So we're going to participate a little bit better on the gains, and we're going to be hurt a little bit more in the losses. And just kind of evaluating off the cuff, back of the envelope, do you think that there's a sweet spot for being funded, or majority of your members funded around the 70 percentile, 80 percentile, or are few of them funded up as high as we are at the 90 percentile? And do you recommend for a member that they target being funded up towards the 90 percentile, or maybe to smooth out the down years, they would be funded a little bit less than 90%?
Yeah. I don't know enough of the details for the specific membership to tell you. I know there's a wide range of degree of funding. That would be a good question for our chief actuary, who would have all those details. In terms of a target level, that really is a preference. If you're risk adverse and you can afford it, and affordability is always an important question, then you can always work to improve your funding and reduce your discount rate. But that's a choice specific to the plan. How much risk are you willing to take to defer costs of running the plan? And some of the plans I've worked at up north, they're 120% funded, and they have a discount rate of around 4%. Well, they paid to get there. They had the luxury of paying to get there. So circumstances vary from one plan to the next, and there's no single good answer, as opposed to understanding our tolerance for risk and the kind of costs we're trying to avoid paying in order to divide a plan. So, and I know it's a kind of a mealy-mouthed answer, but it's very bespoke to the circumstances of the plan and the risk appetite of that plan.
Okay, thank you for that. And I thank you again for the presentation tonight, and thank the commission for their indulgence.
All right, thank you.
A follow-on question based on what those questions he just asked. Of the cities and counties that are similar to us, where they have the entire plan with CalPERS, is their asset allocation the same as ours?
The answer, sorry, I was just coughing. The answer is yes. So the allocation is for the PERF, which is the aggregate of many of these plans.
Yeah, okay. Thanks.
Mr. Gunn, a couple of questions. I'm just looking for two quick numbers. You might have shared, I didn't take good notes. Per your constitution mandate, what is the cap for private equity?
There's none.
You might have mentioned it.
Yeah, there is no mandated constitutional cap on private equity. Instead, our allocations are affected by, again, trying to get the returns we need.
So I'm sorry, I'm going to interrupt because I'm just looking for a quick, if you don't have it, you don't have it.
No, there is no cap. There's no constitutional cap on private
So is there a cap? So if you want, you can go ahead and put 100% in there? Is that what you're saying?
I think if we wanted to,
you can.
We'd also have to get approval of that, but I wouldn't recommend that.
Okay. Yes, but okay. And so
I just wanna-
currently,
I just want to add that that's constrained by the board,
Yes.
right? So we have a
So-
board approved.
okay, so what did the
target.
board approve? What's the max? They approved 13% for the last cycle?
So the last cycle was 13% plus or minus 5%.
Okay, and do you know what it's going to be for the next cycle?
We showed a candidate portfolio, which if they accepted would be 70% plus or minus 5%, but that's yet to be determined.
Okay, thank you.
Are there any other questions?
Just one more, and this might be, I think you kind of alluded to it a few times, this might be an actuarial question more so than one that you can address, but we've been talking about the 6.8% bogey number forever. How does that relate to our current retirees and our situation going forward with our personnel? Is that number going to make it, or do we need to be talking to your actuary to find out if there's other funding that's necessary in order to meet our future requirements?
Right. So the actuary has the answer to that question.
Okay.
Again, because I don't know your specific circumstances.
Right.
The actuaries have your details.
Okay. That's all I have. Thank you.
Okay. Any other questions?
I just want to make a comment to the board, but if they're going, just common sense, if they're going from 13 to 17 for private equity, and that was the problem or the problem before for them not reaching the 6.8, I don't think they're going to reach 6.8 again, because they're just not doing anything different that I heard or understood maybe.
So if I could just expand on that comment, if I may.
Sure.
Of course.
So the problem in the past was we stopped doing private equity. We were very inconsistent in managing our exposure and allocation to private equity over that period of time. So if you look, the allocation, the proportion of private equity portfolio actually declined after the financial crisis. So we spoke to that last September about the inconsistency in maintaining our exposure to private equity. So it's not that private equity as an asset class is problematic, but rather was whether or not we were consistent in maintaining our allocation to private equity.
Okay, thank you.
No, you're welcome.
I just also wanted to add that on our public website, we do have all of the members of the pension fund, the actuarial reports. And so I just went there, I searched the Redondo City Beach, and there's 2020, 2021, 2022 for both miscellaneous and safety. If you'd like to reference those, they're online.
Okay, thank you.
Mm-hmm.
Doug? Do we need to take a motion to
Receive and file.
receive and file?
Yes, but before you do so, I just want to comment, there aren't any public comments on Zoom or e-comments.
Okay, great, thank you. Can I get a motion to receive and file?
So moved.
Second.
And should we have a roll call? Or?
Sure, we'll do a roll call vote. Commissioner Allen,
Aye.
Commissioner Jesty,
Aye.
Commissioner Marin,
Aye.
Chair Castle,
Aye.
Commissioner Woodham,
Aye.
Commissioner Samples,
Aye.
Commissioner Sherbin.
Aye.
Okay, thank you. And thank you for the presentation.
But thank you for the opportunity and the questions.
Yeah,
for
thank you very
having us.
much. And Stephanie, make sure that you just, we'll touch base by email, and you can let me know what the requests are from the committee, and we'll make sure we get that to you. So thank you all. Appreciate it.
All right, thank you.
Perfect. Thanks so much. We really appreciate it.
Okay, next on the agenda is the discussion of participation in the independent auditor selection process. Stephanie.
Before we go further on the next item, we do have Stephanie Meyer, Assistant Finance Director, and Wendy Colazzo, our Finance Director, is also here. So I think Wendy's going to speak on this item.
Yeah, so I'm going to punch the time card in for you guys and actually work a little bit, give Stephanie a break here, right?
Okay.
So for this item, it's just the discussion of the independent auditors out to market that we're going to do for the RFP. As it was noted in, previous council meetings, as you'll recall, for those that have obviously been on the board, the audit services were awarded in 2017. Laysol and Lungard are auditors, LSL. We've also taken a two-time, one-year extension, and that was based on the Financial Services Department transition, as you all were aware. So we're here now as the contract prepares to expire June of 2024, and our plan, is to RFP out with a January 2024 schedule. In order to be on time and target to get auditors on board, whether the existing firm, if they end up winning again, or a new firm by March, in order to be online with December ACFR financials and kind of get right back on, because as you know, we're doing ACFR right now, so we're going to take a holiday break and then get them back in action in March to be in December. It has been customary, and just wanted to make you aware that we require or ask this commission to have a representative on the interview panel to review the submissions, and typically or historically, it has been the chairman. And so this item, like I said, is obviously to make you aware of that procedure, and also to please point to the person you would like on the commission to be on the oral interview panel for the selection process.
If you don't want it, I'll take it. If you don't want it.
I mean, I would be happy to serve and help.
Wonderful. So, Doug, I'm not sure if you need some vote or a motion for that.
Appoint them, or?
I
We
nominate
just
our
all
chair to
agree.
be appointed to the board.
Second.
All in favor?
Aye.
Any opposed? Okay. Thank you.
Thank you.
We need to receive and file this document as well.
Yes, and before I do so, again, there are no public comments, no e-comments, and no comments on Zoom.
Okay.
I would just like to thank the financial services folks here that they're actually bringing this up months in advance. Typically, this happens in the 11th hour of the 11th month, and this is really refreshing. Thank you.
Sure.
Should we have a roll call vote to receive and file?
Yeah, usually for any discussion item, we like to do a roll call
Okay.
vote.
Could we have a roll call vote, please?
Okay, did you guys have a motion? You guys did a motion to receive and file, correct?
Motion to receive and file?
Second.
Okay. Commissioner Allen?
Aye.
Commissioner Jesty?
Aye.
Commissioner Warren?
Aye.
Chair Castle?
Aye.
Commissioner Woodham?
Aye.
Commissioner Samples?
Aye.
Commissioner Sherbin?
Aye.
Thank you. Next, are there any member items and referrals to staff?
Well, since I'm not going to see, or we're not going to see each other until next year, Merry Christmas and Happy New Year.
One comment about the CalPERS presentation. As you know,
Say aye.
as you know, I've been critical of their reporting, not their performance necessarily, but the reporting. And we seem to have that buttonhole now. If you all can show us how to get to quarterly returns, or if you can find the quarterly returns and let us know what they are, that would be very helpful. The only comment made in that whole thing from them that I would question is when I asked what was the premium on private equity compared to public equity. The idea that that's somehow disclosing to the world what they're doing and they can't disclose that is preposterous. And
What are we going to do about it?
yeah, so, but I think the presentation went well. And to your question about, you asked what kind of confidence we can have that the next 2 years will add to that, our 6.8. And it's interesting, if you look at the last 10 years, last 10 fiscal years of their returns. This will, I think, answer your question. It shows the volatility. Beginning in fiscal 14, 18.4%, 4.8, 0.6, 11.2, 8.6, 6.7, 4.7, 21.3, negative 6.1, and positive 6. This is all with roughly the same asset allocation they have right now. It just is an example of how the market varies with the same benchmark, the same investments. So we could come up in the next fiscal year with a positive 20 or negative 5, and that there's no way to know and no way to predict.
I think my only point with that was to especially the last 5+ years, the market has been very volatile and they have not adapted very quickly. That's why you see 21% one year and negative 5% the next. You can't time the highs and lows, but you can certainly capture the mid-range and be much more stable. And I don't know if that's any real value in this discussion or not. What I am curious about, though, and I don't know if we can get it, is the actuarial reports.
We have them.
To see if the city should be making some kind of provisions for what's going to happen in the future if we are going to see this kind of variability.
And I think, to elaborate on this discussion, this is a two-part discussion, right? You have the investment side, which you received today, and then the actuarial side, right? Because it's a give and take, as you know, and there's different parameters. We have found, and I think the opportunity in this entire evolution is that given that you have a new financial services, staff, we were able to jump on this and get educated to answer those questions that seem to be lingering for years, and starting to connect this thing where we found and have found some tools that we're going to use and come back to financial services doing some arithmetic to do some things beyond the crystal ball. Because remember, like anybody says, you're not going to get anybody on any side to say this is what's going to happen. And you all know that. So our goal is to just add the customization that we need for our demographics. We see some changes in, our classic members are retiring, so we're getting more PEPRA. That's going to have some change. We're going to try to do some logical math because it isn't a science, but overall, bridging the gap between the questions that you all have had, getting these reports. Mr. Woodham, we're here for this commission to serve. I don't mean a la carte every time, but we will get you those reports, not just point you in the right direction on a cyclical basis for you to all have that information and, fill your hearts, with it. So, but like I said, overall, I think we have these final things to kind of customize a little bit more how these things may affect us and maybe estimate and forecast a little bit better. And they do have a forecasting tool that they've given us that we know about that we'll go play around with and really, find out what it could really do, right? To help budgetarily make those plans be a little bit better prepared, try to get in front of it as much as we can.
Do we have the actuarial report electronically, or is it just in paper form?
We do, and as the CalPERS representative said, they're actually available publicly as well. Any member of the public can go online and pull down our actuarial reports, but we're happy to send them to you as well.
If you could, I think it'd be helpful.
Yep, yeah, definitely. And I think to Wendy's point and, to kind of the idea of planning, it is kind of it's a long-term, something we're looking at long-term. And we can't control, obviously, the market. We can't control CalPERS' schedule. What we can control is, getting some kind of expectation of what our resources look like and what kind of resources we want to devote to this. So that's what we'll be working to do for this committee in the city.
It's been a good exercise. It's been a daunting couple of weeks, going through this, just because we, had people on ledges, rightfully so, because it is, but we've learned an exuberant amount, as far as from the actuarial side. We have some time to amortize some of these things. It's not an immediate punch to the budget as we see, right? So it's a marathon, not a sprint. But I think the most valuable thing we've gotten is to be able to understand the questions that you all have presented, have more heads in this than just us, and then trying to make sure that we give you logical matter of fact. It makes sense, right? And stop this kind of gap. We're trying to recover from whatever happened before, I don't know. Whatever rep was here, we don't know. But I think we've made a lot of progress to be able to unify again with this commission to do what I guess our intent is, right? Is just to make and have the best information, make the most logical, recommendations. And that's what we need you all here for. So we appreciate the homework.
Well, I feel more confident in what I know about what we're doing now than I have ever on this committee, and a large part of that is due to you guys being responsive to our request for information, so thank you.
Well, thank you.
Any other comments? Motion to adjourn?
Is there a motion to that? Make a motion to
Motion to adjourn?
Second?
All in favor?
Aye.
Aye.
We are adjourned until next month.
Wednesday.